Hello there, welcome to this edition of Global Business Africa. In the next half hour, we'll make a speed run through all the key business news stories that are making the headlines right across the African continent. Here's what's coming up. The World Bank's Doing Business report in 2015 is in focus. We'll also be looking at the gains that Liberia has made so far in dealing with the Ebola outbreak. And a little later in the program, we'll be looking at why Kenya is phasing out tax incentives. Now, tonight's bulletin starts with the latest edition of the World Bank's Doing Business report. It indicates that 35 of 47 economies in sub-Saharan Africa implemented at least one regulatory reform that made it far easier to do business in the 2013-2014 fiscal year. Now, Mauritius has the region's highest ranking on the ease of doing business at position 28 out of 189 economies worldwide. South Africa is next at 43rd. Rwanda is 46th. Rwanda implemented the largest number of reforms in the region during this period, followed by Mauritius and Sierra Leone. For the first time this year, the Doing Business report collected data on a second city in the 11 economies covered. In Nigeria, for example, the report analyzes business regulations in both Lagos and Kano.
Out of the 189 economies that we cover, it's easier to do business this year. Entrepreneurs have an easier life this year. In particular, in sub-Saharan Africa, there was a great improvement. Out of the 230 reforms that we recorded this year, 75 took place in sub-Saharan Africa. For instance, Senegal improved significantly starting a business, and this has been a continued reform throughout time. Most of the indicators in the Doing Business report are about regulatory efficiency, so how quick and how cheap you can get a transaction completed, starting a business or transferring property, for instance. But this year and the next, we're trying to expand several of the indicators to also measure the quality of those transactions. So we're not just checking if you're doing it fast and cheap, but are you also doing it well? South Asia, actually, it's a region with a lot of new data this year because we expanded the number of cities covered in India, Pakistan, and Bangladesh because all of those countries have more than 100 million people each. So with that new data, we can expand the information that we have and we can compare differences within countries. So there, for instance, we find that the process of getting electricity in Mumbai versus Delhi has been improved substantially in Mumbai and not so much in Delhi. This year's Doing Business report finds that one of the regions where there's less incidence of reform is Middle East and Northern Africa. And that's, I think, in part because of the civil unrest. Although it's a very diverse region, and there are economies where the reform pace is actually quite intense. So in particular, the United Arab Emirates has implemented 3 reforms, and it's one of the top 10 improvers this year.
Now, to date, over 5,000 people have been killed in the Ebola outbreak. Most of those killed have been concentrated in 3 countries, Sierra Leone, Liberia, and Guinea. Liberia, however, is starting to see some results from the international help that has been sent in so far to deal with the outbreak, as the number of safe burials increases and lab testing times are dropping from 5 days to 5 hours in some remote parts of the country. That said, Liberia's government has now warned of the negative economic impact of this epidemic. As Katerina Vitozzi reports, some Chinese firms among those that have cut operations in the country due to safety concerns.
This equipment was being used in one of Liberia's biggest infrastructure projects in decades. But now it stands idle in a car park.
Before Ebola starts, no equipment should park here. All the equipment go to the site to work on the site. But this time, look at this. All equipment have to park here. No work to do because Ebola stopped our works.
Last year, Chinese construction firm SECO won an $80 million road building project in central Liberia. The 90-kilometre road was more than half finished until Ebola struck.
Before Ebola to break out, we have 3 teams work as 3 sections. but when that is come out, we have to stop all the main works. For example, for construction of the roads and some actual work on the site. Most of them stopped. Only the maintenance the roads and the quarry site is working now.
Concerns over staff safety led the company to calling a force majeure. Now just 30 of more than 100 Chinese staff remain in country. They carry out maintenance on the parts of the road they've already built.
If we finish this project on time, we can get the payment on time. And for this project, we spend plenty of money, but we cannot collect money on time because Ebola.
Trade between China and the three worst affected Ebola countries was more than $5.1 billion last year. Bosses here hope their project will soon get back on track.
Our plans, if the Ebola is over, we'll start to restart these works. According to our latest plan, we hope we can start work at the beginning of the next year, so we can carry on this project.
The Chinese embassy here in Liberia has never officially warned Chinese citizens and businesses to leave the country. Indeed, it's tried to encourage them to stay open where they can and if it's safe for them to do so. But 7 months of this epidemic has taken its toll on all businesses, with the Liberian government warning that economic growth for next year could be close to zero. Katerina Vitozzi, CCTV, Monrovia.
On to East Africa now, where Kenya plans to scrap the tax incentives that foreign firms setting up operations in the country have enjoyed for quite a while now. According to government estimates, tax incentives cost East Africa's biggest economy over $1 billion in tax revenues every year. And now policymakers have concluded that they're unsustainable and frankly aren't doing any good, really. The head of the Kenya Investment Authority, Dr. Moses Ikiara, said the plan is to retire the many current tax incentives and to align the tax incentive used by the central and devolved government. East Africa's biggest economy does offer a number of tax incentives to foreign companies which manufacture goods locally for export. They include a 10-year corporate income tax holiday, a 10-year withholding tax holiday as well, especially on repatriated dividends and other remittances, exemptions for foreign investors from VAT, import duty on inputs, and payment of stamp duty on legal instruments. Now, on top of that, they also qualify for a 100% tax deduction on new capital investments. That's obviously a mouthful to get through. Let's get some more analysis on Kenya's move to end tax exemptions. I'm now joined by Xavier Mwamba. He's a Policy and Advocacy Manager at the African Tax Justice Network. Thank you for your time this evening.
It's a pleasure.
Looking at East African economies as a whole, especially Kenya, Uganda and Tanzania, how did we get to this point where we've got a race to the bottom in terms of tax incentives?
Well, I think you'll be interested to know that it's not just East Africa. But what's unique with the East African countries that I think is one of the most advanced regional bloc in Africa. A lot of advances have been made around regional integration, around having common trade policies, around that. And yet you see individual countries within the region pursuing sort of contradictory policies. So it's understandable why most governments would offer tax incentives. For example, most of African governments are under huge pressure to attract foreign direct investment. Because of course they have to create jobs, they have to satisfy their election promises, and it's understandable. However, I think one has to look at tax incentive as just one of the many tools, in a toolbox of economic policy instrument that governments can use to attract investment. So I think it's a very welcome move that the Kenyan government has decided to review and stop this giving these tax incentives, because now we know there's enough evidence that tax incentives do not necessarily lead to more foreign direct investment. In fact, what tax incentives do is they divert investment. So for example, if the total amount of investment in East Africa was X amount, if one country gives incentives, it will just divert a portion of investment from the other two countries to the other country. So the whole region is not necessarily better off, it's actually worse off.
If anything,
so
they're actually leaving a lot of money on the table.
Exactly. So, and companies actually do not make their investment decision in terms of prioritizing tax decisions. It's other factors like the head of the
size
investment,
of the market and so
size
on.
of the market, educated workforce, etc., etc.
Right.
So I think it's long overdue for African governments to go this way.
Let me take you back to 2012. A report by your organization and ActionAid focused on these particular incentives, and at the time the figure we're working with was $1.1 billion in annual losses attributable to tax exemptions. What's the situation been like in the last 2 years? Have we seen any changes? Are the losses still at that level? Have they gone up? Have they gone down?
Well, the losses are certainly huge, and the thing is that you can quantify the loss or benefits in tax incentives. There are different kinds of incentives. Tax incentives are just one of them, but countries continue to give other kinds of incentives that are difficult to quantify. So I think those estimates we did when we did that study were just sort of the modest, rough estimate.
So essentially this 1.1 figure is actually an underestimate of the
Yes,
problem.
if you add other non-tax benefit. But I think the picture is changing for the better.
Yeah.
So apart from Kenya, for example, other countries in Africa are reviewing their stance on tax incentive. In Zambia, for example, they're also doing a review with a view of renegotiating some of these incentives and also doing away with some of them. The problem actually is not with the incentives themselves. The problem is that most African governments do not make an effort to actually do an analysis of what are the benefits, to quantify the incentives and tie incentives with actual benefits. How many jobs have been created because of these incentives? How many industries? How many technology
tech transfers.
technology transfer, etc., etc. There's no tracking, so that we are able to say that yes, because of X incentives, Y amount of jobs have been created. So I think it's one way of doing it is that if you can't measure something, if you can't count something,
But
don't give it.
is a capacity to measure those incentives effects available across Africa? Because we often talk about the data gap across Africa, the ability of governments to actually collect the economic data that they need to make decisions on a rational basis. Is the capacity to actually measure this there?
Well, there are two factors. One is the technical one, where capacity can come in. The other is more ideological, more political. Remember, after the World Bank infamous structured adjustment program, most of our governments pursue neoliberal policies where they have to liberalize everything. And like I said before, their daily preoccupation is to see how can they attract foreign direct investment. And incentives, for some funny reason, are very attractive for most politicians because one, they are discretionary. Politicians can just give them, they can choose which companies get incentives. So I think it's more like a fashion. And because your neighbor doesn't want to be left out, if they see Kenya giving incentives, Uganda also do the same, Zambia will do the same, because they think
because the fear is,
the company will move the other way. And that is the rest to the bottom. But however, what we need to do is to look at the empirical evidence. And in terms of economic theory, actually what incentives do is they distort the market. And what governments should be doing, like in East Africa, is to cooperate and not compete. They should actually make companies compete. For resources, they should make companies compete. Companies should show that if you give me a mining license, or if you give me a license to invest, I'll create X amount of jobs, I'll pay X amount of taxes compared to that company, not the other way around. Currently what's happening is that companies are pitting governments off each other. So I think we need to change the picture, and it's a good thing that that trend is changing and governments are realizing that.
Let's talk about the VAT Act in Kenya. It came into force in September 2013, overhauled the law that was there in its place. To what extent has it mitigated some of these tax exemption losses that we've been looking at? And do we need to do more with regard to VAT to actually lock out whatever loopholes still remain?
Well, I think from the government perspective, the positive side that VAT is a very easy tax to administer. It's a simple way of doing it because the administrative costs are low. Governments don't have to collect it themselves. The KRA doesn't have to do it. The traders do it for it. But also, it tries to capture as much of the tax base available. That's a plus for the government side. Unfortunately, it's an easy way out because what VAT does, because it's not regressive, it punishes everybody. It's not sensitive to how much income. So if I'm not working, for example, I still have to pay it because I consume. So what VAT does is that it punishes the poor. And in that sense, it promotes inequality. For the other kinds of taxes, like corporate income tax, that's where government should be targeting because companies make profits. Unfortunately, some of the profit tax are also difficult because of transfer pricing and all this other kind of thing. So really, governments are losing out in a double way. They're not collecting enough corporate income tax because they're giving away all these incentives, but also companies are able to manipulate the laws and also involve in all these schemes. So really what government should focus on is to go for something that is simple. Go for tax systems that are easy, that are simple. So one way is, for example, if tax incentives are very difficult to administer, they're very difficult to measure, then they should do away with them as the Kenyan government is doing. Value-added tax should also be designed in such a way that it's very sensitive to the different income bands of the population, and there should be provision for VAT exemptions.
Yeah.
So goods that the majority or the vulnerable people depend on, or health-related goods, should be exempt, for example. So I think you cannot apply VAT across the board as well, and that was the problem with the Kenyan VAT regime.
All right, we'll have to leave it there for the time being, but thank you very much for your input tonight. We've been speaking to Xavier Mwamba. He's the Policy and Advocacy Manager with the African Tax Justice Network on plans by the Kenyan government to phase out progressively at that the tax exemptions that it has been giving to foreign companies. Let's move on to Zimbabwe now. President Robert Mugabe is hit out at local business people whom he claims are sabotaging the country's indigenization laws, which compel all foreign-owned businesses to cede at least 51% of their shares to local owners. Now, he made those comments on opening the second session of the country's 8th parliament, in which his ZANU-PF party controls more than 2/3 majority.
The president had been under the radar in recent weeks, the spotlight firmly on the First Lady and her foray into mainstream politics. But today, Mugabe was back in the driving seat, reiterating the government's stance on indigenization and saying there would be no going back. The empowerment laws have been criticized for scaring investors and stalling economic recovery. In recent months, there had been talk that government might soften its position, which makes it mandatory for all foreign-owned firms to give up at least 51% shareholding to locals. Mugabe castigated locals who are conniving with foreigners to circumvent the law.
It is depressing that some of our people have turned themselves into mere fronts for foreign investors, thus defeating the fundamental objective of the indigenization and economic empowerment program. Decisive action shall indeed be taken to address these negative developments and to strengthen the general enforcement of the relevant legislation.
Other priority pieces of legislation in the next session of Parliament include a public health bill which will improve service health delivery, a new education curriculum, approval of plans to build a new state university in Manicaland province, and upgrading of a regional defense college into a defense university. Farai Mwakutuya, CCTV, Harare, Zimbabwe.
Let's make a quick run through equity markets here for you. A fairly positive day across the board, except for the Nigerian all-share. That was down by about 1/3 or so. However, in the year to date, the NSE in Nigeria is actually in the red. It's down by about 4 percentage points in comparison to all the other major bourses in Africa, Nairobi in South Africa and in EGX, all of which are firmly in positive territory. EGX, for example, is up by 30% so far in the year to date. We'll be focusing on a conference in South Africa that's looking at large-scale land acquisitions and land grabs in Africa. And we'll also be looking at tourism from a rather different perspective next. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening. Welcome back to the program. You're watching Global Business Africa. Now, let's take you to a conference in South Africa, specifically one that was in Johannesburg that heard that more land has been grabbed in Africa in the last 14 years than in the rest of the planet combined. Land grabs, of course, in this context are things we define as large-scale land acquisitions that displace vulnerable communities and completely disregard human rights and social and environmental impacts. In What's Hot Tonight, Angelo Coppola explores the conversation at the conference and what that may portend for the continent.
According to research presented at the conference, over 55 million hectares of land in Africa has been illegally grabbed since the year 2000, and it continues unabated. NGOs and academia are starting to raise the issue continentally in an attempt to raise awareness and to try and find some workable solutions.
We're looking at sustainability, we're looking at governance, and most of all, we're looking at beneficiation. Generally, like you say, land grabs happen to be it's a very sensitive subject. And the idea behind this conference is, first of all, to have a platform where we start to talk about these things, where there is dialogue. Because so far, we seem to have been talking past each other.
On a philosophical level, land grabs are seen as part of a far bigger problem.
Yeah, it's about the ethical dilemma we are facing. We vote people into power, and then all of a sudden, those who are in power, they forget the constituency which they are representing. They forget the mentorship or the support they could get from the people who are there, the intellect. And as it were, they end up in these traps, and which we call land grabs.
The problem is widespread and not confined to any particular geography.
Interesting to note that even universities using their hedge funds are actually trying to grab land. That's Western universities. We have politicians. It's not only a foreign problem, but we also have locals, citizens of the respective countries who are politically connected, who are actually grabbing land.
Land grabs take on many guises. In Botswana, there are 3 types of land ownership: state land, tribal land, and freehold. The largest proportion is tribal land at around 75%. But the problem isn't in the rural areas, it's in the cities and towns.
In the urban areas also, there are people who acquire land which is meant for civic and community, which are more for the use of the community. But then they change that land into other uses like commercial centers, which are meaning they are changing the use so that they can make more money.
When you think of land grabs, you traditionally think of large tracts of open agricultural land that are stolen by corporates. However, there's also the peri-urban stuff that you've got to watch for. The bottom line is that if the policies and procedures aren't in place, people will take advantage, whether they're foreigners or locals. I'm Angelo Coppola for CCTV in Midrand, Johannesburg.
Now, Zambians do continue to mourn the death of their deceased president. Let's examine exactly how the economy fared under Michael Sata's time in charge. He, of course, won the presidency in 2011. At the time, he pledged to overhaul the economy during his tenure. While he was in power, however, Zambia's economy created over 316,000 multi-sector jobs. Copper prices also improved over the years, partly due to demand for that commodity. Inflation has been below 7%. Lending rates have fallen to under 16%. FDI inflows have already surpassed a government target of $3 billion by over $500 million this year alone. Now, combined with GDP growth rates of over 6%, that has collectively increased investor appetite for this frontier nation. However, there are plenty of negatives as well. Economists say a prolonged period of turbulent politics may have affected the country's ability to progress even further. And of course, the expansionary politics that he pursued on the economic front are now causing quite a bit of chaos. Let's move on to Ethiopia. It's set to invest about $600 million in a solar power generation plant, and it has already put pen to paper on a deal with a US firm, Green Technology Africa, to undertake the project. Now, once complete, it's expected to put in about 300 megawatts of solar power in the country. This green tech company says it will seek project financing from the US Power Africa initiative, which was launched by President Barack Obama last year, with the aim of doubling the number of people in sub-Saharan Africa who are connected to the grid. The Virginia-based GTA says solar development in Ethiopia would be a welcome addition to the national grid. Ethiopia currently has 9 dams and it's building plenty more. Collectively, the existing ones provide close to 2 gigawatts of electric power generation capacity, and it's making an aggressive drive to boost capacity from even more sources, including wind, solar and hydro. The idea in Ethiopia is to expand national electricity coverage to 75% by next year. Now, quick run through commodity prices here for you. Crude oil around 87.21 in trading so far today. Close eye, of course, on the meeting of the Fed. Will they end QE as expected by many in the market? And if they do, when will we start seeing a rise in rates? Next year? Next year but one? We're waiting to see. When the news comes out, you'll know about it right here on CCTV.
BizAsia. Asia means business.
Welcome back to the program. Innovation is key in any business sector. Tourism is no exception. Now that, of course, is a mantra that has meant big money for destinations around the world. Here's one example for you. Thousands of spectators showed up for the now popular high-heeled drag queen race on Tuesday. They were there to cheer on close to 100 drag queens dressed in fairly elaborate costumes as they raced each other in Washington, D.C. The annual race is one of Washington, D.C.'s more unique Halloween events. It's been taking place on the Tuesday before Halloween every year since it started in 1986, with only 25 contestants. Now, most of these guys have participated before. Spectators cheered, joked, took pictures as the drag queens walked or raced by. The race, of course, has influenced the creation of similar drag races in other countries as well.
I've been walking in these things since I was a little boy, so I've got this down. I've got this down. Running's a piece of cake.
Last year was my first time. It was unbelievable, so here we are again this year.
You not only get to come out and see this, but you get to socialize, mingle some. And it's very, very good on a day like today. We've had an awesome day.
Oh my God, did I really shave my legs for this?
And finally, China is experiencing a baby boom of sorts, especially as a result of the country's long-standing one-child-per-family policy being relaxed in many provinces. Also because this is the year of the horse. And in Chinese culture, that's known to bring divine blessings as well. Now, prospective parents in China prefer to have their kids born in the year of the horse. It's known as a period of good fortune and dynamism. And these are qualities that are revered in that culture. In addition, the Chinese government has relaxed its one-child policy in 29 of 31 provinces. That allows couples now to have a second baby if either parent is an only child. Baby product retailers say relaxing the policy combined with the year of the horse have meant an increase in sales, which is always useful for their bottom line. The baby boom has pushed up the sales volumes of mother and baby care products to 8 billion yuan in 2014. Online sales have even grown by 30% year on year. Now, of course, with regard to currencies right across Africa, what we're keeping a close eye on is a decision that will come out of the Fed. Across the board, we're looking at some fairly interesting developments that will have a ripple effect on the Naira and the Rand. The Rand, of course, was relatively steady a little earlier in trading yesterday, and we're seeing broadly a continuation of more or less the exact same trend today as well. That's it for this edition of Global Business. Send your feedback to globalbusinessafrica@cctv.com. And of course, whenever we're offline, you can check us out on our content as well on Facebook and on Twitter. The handle is @CCTV News Africa. As always, thank you very much for watching. See you in 23 hours. I'm Ramanya.